All right, listeners, ready to dive deep. Today, we're tackling sovereign wealth funds, those government-owned investment giants managing trillions of dollars globally. They've even been involved in some high-profile stuff, like helping to bail out banks during the 2008 crisis. We've got some great sources to unpack here, including an article from the Financial Review that really digs into the debate about whether the U.S. should jump on this SWF train.
It's a fascinating question, and it goes beyond just the U.S. globally. These funds are becoming increasingly powerful players in the financial world.
So let's start with the basics. What exactly is a sovereign wealth fund, and why are they such a big deal?
At their core, SWFs are investment funds owned and managed by governments. Think of them like a country's savings account, but instead of just sitting in a bank, that money is actively invested in a variety of assets, stocks, bonds, real estate, you name it. What makes them so significant is the sheer scale of their investments. We're talking almost $13 trillion globally.
Wow, that's a lot of zeros. But it sounds like they're not all created equal. There are different types of SWFs.
Right. Absolutely. Some countries use them as a rainy day fund, a way to stabilize their economy during tough times. Others are focused on saving for future generations, particularly countries with large natural resource revenues like oil or gas. And then there are SWFs with specific strategic goals, like investing in key industries to boost economic growth.
Okay, so these SWFs can be pretty powerful tools. Let's get into the potential upsides. Why would a country want to create one in the first place?
Well, imagine you're a country that suddenly discovers a massive oil reserve. You're going to have a huge influx of revenue, but that revenue might not last forever. And SWF can help you manage that windfall, investing it wisely to create a long-term source of income and diversify your economy beyond just that one resource.
So it's like a giant safety net, making sure you don't put all your eggs in one basket.
Exactly. And beyond just resource-rich countries, SWFs can be a way for any nation to invest for the future, whether it's building infrastructure funding, research and development, or even supporting social programs.
It sounds like a pretty attractive option, but I'm guessing there are some potential downsides too.
Right. There are definitely risks and challenges that come with managing these massive pools of money. One of the biggest concerns is the potential for political influence. You can imagine the temptation for politicians to dip into the fund for their own pet projects or to try and sway investment decisions for political gain.
That sounds like a recipe for disaster. What about the argument that the U.S. doesn't need an SWF because we already have robust capital markets? Isn't that enough to support investment and growth?
That's a key point raised in our source material from the Financial Review. They argue that the U.S. already has deep, efficient capital markets, meaning companies and investors have plenty of ways to connect without the need for a government-run fund. Plus, they point out that some U.S. states like Alaska, with its permanent fund, already have successful SWFs. So why add another layer at the federal level?
So from their perspective, it's a bit like reinventing the wheel.
That's one way to look at it. They also highlight the political challenges. Imagine trying to get an SWF approved in the current U.S. political climate. It would likely be a highly partisan battle with concerns about government overreach and potential misuse of funds.
Yeah, I can see how that would be a tough sell.
Yeah.
But even if we could somehow get past the political hurdles, wouldn't there be another big elephant in the room? The national debt?
Absolutely. The U.S. already has a massive national debt. Where would the money for an SWF even come from? Raising taxes to fund it would be incredibly unpopular, and borrowing even more money would just add to the debt burden. The Financial Review article makes a strong case that it's simply not fiscally responsible for the U.S. to take on another huge financial commitment right now.
So we've got the unnecessary argument, the political nightmare argument, and the fiscally irresponsible argument. That's a pretty strong case against the U.S. SWF, wouldn't you say?
It certainly does raise some serious questions. But even with all these potential downsides, it's important to remember that there are successful SWFs out there. Norway's sovereign wealth fund, for example, has been lauded for its transparency, strong returns, and contribution to the country's economic stability.
That's a good point. It's not like all SWFs are destined to fail or become political pawns. Maybe there are ways to design one that could actually work for the U.S., even with all the challenges we've discussed.
That's where the research gets really interesting. Our source material actually highlights some key areas where we need more information to make informed decisions about SWFs, particularly in the context of the U.S.
Okay, so less speculation, more data. I like the sound of that. What are some of the big questions that researchers are grappling with?
One of the key questions is how effective SWFs actually are at boosting domestic economies. Do they really help to stimulate investment and innovation, or do they create distortions in the market? This is especially relevant for the U.S., which already has a very dynamic and complex economy.
So it's not just about whether an SWF can make money, but whether it can actually make a positive impact on the broader economy.
Exactly. And that impact can be hard to measure. Researchers are also looking at the role of SWFs in developing healthy financial markets. Do they contribute to market stability, or do they create new risks? And how do they interact with existing regulatory frameworks? These are all crucial questions that need to be explored further.
It sounds like there's a lot we still don't know about the long-term effects of SWFs, both positive and negative. But what about the specific challenges of setting one up in the U.S.? Are there any ideas out there for how to address those concerns?
There are certainly some potential solutions being discussed. For example, to address the issue of political influence, you could create a highly independent board of directors with strict conflict of interest rules. Transparency and public accountability would also be crucial.
So no shady backroom deals or politicians using the fund as their personal piggy bank.
Exactly. Regular audits, public reporting, and maybe even a citizen oversight board could help ensure that the fund is being managed responsibly and ethically.
Those sound like good safeguards. But what about the funding problem? Where would the money for a U.S. SWF actually come from? We already talked about how raising taxes or borrowing more money are both pretty unpopular options.
There are a couple of other ideas being floated. One is to dedicate a portion of future budget surpluses to the fund. Of course, this assumes that the U.S. will actually have budget surpluses at some point, which is far from a certainty.
Yeah, those surplus unicorns seem to be pretty rare these days.
Another option is to allocate a percentage of revenue from specific sources, like federal lands or mineral rights, to the SWF. This could provide a more stable stream of funding, but it would likely face opposition from states and industries that currently benefit from those revenues.
So a political battle royale either way. Sounds about right. But even if we could somehow overcome all of these challenges and create a well-designed, well-managed U.S. SWF, there's still that fundamental question, do they actually work?
And that's precisely why this research into the effectiveness and impact of SWFs is so important. We need data, not just opinions, to guide our decisions.
Okay, so we've covered a lot of ground here. We've explored the potential benefits of SWFs, dug into the reasons why a U.S. version might be a tricky proposition, and even touched on the need for more research to guide our understanding. But before we wrap up this deep dive, there's one more fascinating aspect of SWFs that I think you'll find intriguing. It's a bit of a curveball.
Oh, I love a good twist. Lay it on me.
Remember how we talked about different types of SWFs? Well, get this. There's a category called wealthless SWFs.
These are a particularly interesting phenomenon. They're essentially funds that don't have any actual capital injections. Instead, they hold stakes in national companies.
Wait, so they're like investment funds without any actual money. How does that even work?
It's a unique situation. These types of SWFs are typically created by countries with significant external debt. Instead of cash, they contribute ownership stakes in state-owned enterprises to the fund.
So it's like using pieces of the national pie as currency.
Exactly. It's a way for these countries to potentially leverage their existing assets to try and improve their financial situation. It's a creative approach, though it definitely comes with its own set of risks and challenges.
I can imagine. Managing a portfolio of companies is a whole different ball game than just investing in stocks and bonds.
Absolutely. It requires a different set of skills and expertise, and the potential for political interference is even greater when you're dealing with actual companies rather than just financial assets.
Okay, so we've got these wealthless SWFs out there potentially shaking things up. But let's bring it back to the U.S. for a moment. Let's say, hypothetically, we do all the research, have all the debates, and somehow miraculously decide to create a national SWF. What happens next? How do we make sure this thing actually works and doesn't just become another bureaucratic mess?
That's the billion-dollar question, isn't it? I think the key lies in those areas for future research we discussed. We need to learn from the successes and failures of other SWFs around the world. We need to understand what governance structures work best, what investment strategies are most effective, and how to mitigate the risks of political influence. We also need to carefully consider the economic context of the U.S. What works for a small country with a resource-based economy might not be the right fit for a large, complex economy like ours.
So no pressure, future researchers, but the fate of our hypothetical SWF rests on your shoulders.
Well, it's not all on them. We as citizens also have a role to play. We need to stay informed, engage in the debate, and hold our elected officials accountable for making responsible decisions about the management of public funds.
So this isn't just some abstract economic concept. It's something that could actually impact our lives.
Absolutely. SWFs, whether we like them or not, are a growing force in the global economy. Understanding how they work and what implications they hold both for the U.S. and for the world is essential.
Well, there you have it, deep divers. We've explored the depths of sovereign wealth funds, from their global impact to the potential and the challenges of a U.S. version. We've tackled the pros and cons, the potential pitfalls, and the unanswered questions. It's a complex topic, but hopefully you're swimming away with a better understanding of these financial behemoths. Until next time, keep those brains buzzing.